The two most popular dividend exchange traded funds is Divvy, symbol DVY, which is offered by iShares, and VIG, VIG, that's the Vanguard Dividend Appreciation ETF. They both serve a purpose, but I could tell you this, they're not close to being similar. The Divvy is down 7% year to date. It follows the Dow Jones Dividend Yield Index of companies that are typically well-known. Atria, that's the tobacco company. Verizon, IBM, AT&T, Walgreens, these are companies that typically pay big dividends, but that's what they're based on. They're not necessarily based on the fundamentals of the company, and that's why it is about 21% lagging the S&P 500 year to date. And then you take a look at the VIG, it's up 5.5%. The yield is not as good. It's only 1.89%, whereas the Divvy is 3.76%. We'll look at the top holdings in this one, and you're going to see a very big difference. This one has Microsoft, Apple, Exxon, United Health, Johnson & Johnson, JP Morgan, Procter, Visa, MasterCard, Home Depot. These are seriously solid blue chip companies that consistently raise their dividend. That's the difference. The Divvy is invested in companies that have higher dividend yields. VIG is not invested in companies that necessarily have higher yields, but it's invested in companies that raise their dividend every year, year in, year out. And that has proven to be a much more effective growth strategy than just buying companies for the sake of having higher dividend yields. So that's the difference between these two funds.